It's a wobbly Wednesday on Dalal Street as the Nifty fails to hold on to the intraday high of 7,900. The SENSEX loses more than 300 points. A perfect opportunity, say brokerages, for investors to enter the market and pick up some good stocks at attractive valuations.
U.S. markets gained more than 1% after the president of the New York Federal Reserve, William Dudley, says a September rate hike looks less compelling now. European markets give up on all the gains posted in early hours of trade.
I don't think all of them are a reflection on China's future, which, given their 7% growth, may still be seen by many as very reasonable.
RBI Governor Raghuram Rajan says it's wrong to blame China for the global turmoil alone. Speaking to BBC, the RBI Governor says there's no reason to believe that we're on the verge of another crisis.
A lackluster day for the currency markets. The rupee ends marginally lower at 66.13 versus the dollar. Crude prices stead after hovering near 6.5-year lows.
Pushed to the wall, the government may now pass an executive order to keep the land ordinance alive. CNBC TV 18 learns the Attorney General has ruled out the possibility of a re-promulgation of the ordinance since the Parliament session has not been prorogued.
The Parliament may be deadlocked, but the Cabinet gets quite a bit of work done, approves amendments to the Arbitration Act for quicker and fairer conciliation, also makes it easier for companies to divest stake in road projects to boost infrastructure.
The Maharashtra government is all set to roll out the red carpet for retailers. A draft policy proposes a single window clearance for license procurement and easier real estate norms, including higher FSI for malls.
The wait gets longer for Indian aviation companies. The Prime Minister's office pushes for wide-ranging consultations on the 520 rule. That's before the overseas flying norms are changed.
Also on the hour, subsidized rice, subsidized essential commodities, and come October 1st, cheaper Indian liquor. That's what the Telangana government is proposing.
Ferrari drives into Mumbai, launches a turbocharged version of its famed California T model, but rules out the option of new showrooms in the country.
ये प्रधानमंत्री के डोर स्टेप पर है। अब डिसीजन जो है अल्टीमेटली प्रधानमंत्री जी ने लेना है, लेकिन जो हमारा है जो है हम उससे जो है हटने को तैयार नहीं है।
Well, on one hand, you have the one rank, one pension agitation where the stalemate between the government and ex-servicemen shows no signs of ending. And on the other hand, the Patel reservation agitation has taken a deadly turn. 6 people have died in incidents of violence reported across the state of Gujarat in the last 24 hours. It's not good news for the Narendra Modi government. Hi, Nandara.
Hi, Shireen. You know, this is something Narendra Modi didn't have to deal with, this tragic news coming in from his home state of Gujarat. He has enough to deal with already.
Well, it is double trouble for the government, but we will get you more on that in just a bit. But pushed to the wall, the government may now pass an executive order to keep the land ordinance alive. We'll get to that story in just a bit. But Dalal Street continues to be our top focus tonight. So let's get straight to it. After turnaround Tuesday, it was a wobbly Wednesday, a seesaw session with the SENSEX and the Nifty ending the day lower by more than 1%. The Nifty finally shut shop below 7,800. The SENSEX shaved off more than 300 points by the end of the day. And And here's some data which could explain why foreign institutional investors, or FIIs, are pulling money out of India. The latest data shows that a whopping 13,500 crore rupees has been withdrawn from the Indian equity markets in the month of August, making it the third highest outflow ever in a single month. And the sell-off has been even more heightened in the last 2 days, seeing a total outflow of more than 4,400 crores, which has taken the total figure above the $2 billion mark, a figure last seen in 2008. Of course, the SENSEX was at a very different level in 2008, and hence the impact of that kind of a cut and that kind of FII outflows was much more significant than what we are seeing today. Anuj is standing by now to take us through the market action. Anuj, another volatile day for our markets, and it promises to be even more volatile given the expiry jitters.
Oh yes, it was another bad day for the market, no mistake about that. The bulls could argue that the market ended where it started, but then that's little comfort. The fact is that the Nifty had a triple-digit fall and it ended below the 7,800 mark. And what was more disconcerting was that again an intraday recovery was sold into. At one point, the Nifty had turned in the green, and by quite a margin, up about 40 points thereabouts. So from that point to have a triple-digit fall was telling you about the kind of weakness that persists in this market and the kind of global cues that we are part of right now. And once again, it was banks that led the fall. And once again, private financials like HDFC, not good news if you are a bull. What was even more disconcerting was that in late trade, even IT and pharma gave up gains. Let's talk about some of the stocks then. First, the heavyweights. HDFC, it's normally the case that HDFC is the most active stock during expiry, and today was no different, 4% lower on that. Infosys was down 2%, and Larsen & Toubro down 2% as well. Banks had a really bad day today, led by ICICI Bank. That stock was down 2%. SBI was down 3%, and IndusInd Bank down 3% as well. Some other losers from across the sectors today included stocks like Ambuja Cement down 4%, Tech Mahindra as well down 4%, and BPCL was down about 3%. Some more names, again, from different sectors. We had stocks like Mahindra & Mahindra lower 3%, Bharti Airtel 2.5%, and ONGC 2.5% as well. On the gaining side, there were some stray winners today, not the real heavyweight stocks like BHEL, Tata Power and Ken. So as I said, they don't really make up the Nifty. It's just that they're part of the Nifty, so the gains look big, but that doesn't help the Nifty. In terms of mid-caps, there were some big winners today. High beta space actually did quite well, and that was remarkable on a day like this. We had Reliance Infra, which was up 9%, Indiabulls Real Estate was up 8%, and PTC was up about 7%. So for now, another bad day. Tomorrow's expiry, it's going to be extremely volatile because it's been that kind of a series, and really the big trigger for us would be what happens to US markets tonight. That really is going to be the big trigger for our market tomorrow as well.
All right, we're bracing ourselves for more volatility. Anuj, thanks very much for joining us. Well, one man who believes the recent moves in China are just a trigger and not the real cause for the sell-off across global markets is the managing director of UTI Mutual Fund, Leo Puri. He says the correction was in fact long overdue, and while the Indian growth story may still be intact, volatility in the short term cannot be ruled out.
I don't think we will see deep trauma setting in for now, but I do think we're going to see a period of stress. Volatility is stress, essentially. And my advice, to the extent I would offer it at this point to the retail investor in India, is that if you are fundamentally invested, please don't panic, because we are a relative standout in the global economy. And I would actually see that staying put is actually not a bad thing to do at this point. I think you will also notice many institutions standing by a little bit for a while on the sidelines. And I think that is already apparent with regard to emerging markets. So I do anticipate that there will be a period of stock taking on the part of global investors, global institutions, while they try and assess what their outlook and allocations are going to be to emerging markets like India.
Volatile times will continue, but if you're a long-term investor, then don't panic. That's the word there from Leo Puri. And speaking of big voices, now the Chief Investment Officer of ICICI Prudential AMC, S. Narain, our alpha manager of the day, believes that the sell-off has thrown up the perfect opportunity for investors to pick up some good quality stocks.
Periodically, you will have global problems, and the time to invest lump sum in equity would be during global problems. If everything was smooth, you would have huge FII buying, and maybe not the time to invest in a very aggressive manner. So I would say that it's good for the Indian investors that you have these periodic global problems to give people opportunities to invest.
It's one expert's view in the Dalal Street, but here's more. India need not worry too much about volatility in the markets. That's the word coming in from the MD and CEO of ICICI Bank, Chanda Kochar. She maintains India's fundamentals remain sound. Listen in.
We are living in a globalized world, and whatever happens in different countries does impact the global risk appetite and does impact therefore the capital flows. Therefore, what we are seeing today is really the interim volatility that is being caused to the financial markets. I would say that at this point in time, we must remember that India is very well placed to weather this volatility.
Chanda Kochar saying India's fundamentals remain strong. The bears are growing and the bulls are faltering. The NIFTY has tumbled below 7,800 for the first time since the 16th of October 2015, and the MSCI India Index has lost over 12% over the last few weeks. While this has raised a flutter about the India bull run among a few investors, brokerages are rubbing their hands with glee. CNBC TV 8's Nimesh Shah and Alexander Matthew get to that story.
Pick up your wallets and go shopping for stocks. That's the advice many brokerage houses are giving their clients about India, even as the Indian stock market struggles to find its feet after its recent battering. A note from Ambit Capital reads, and I quote, "The recent sell-off offers a buying opportunity in high-quality names. Many of our sell recommendations are close to becoming buys." The note names 10 high-quality buys. That's stocks with high-quality franchises and limited negative surprises as far as near-term earnings estimates are concerned. These include ITC, Coal India, Lupin, Power Grid and IndusInd Bank in the large cap space, and Page, PI Industries, Mahindra CIE, Bata and City Union Bank in the mid-cap space. Ambit is not alone in putting out a shopping list for its clients. Phillip Capital's India strategy note titled "Catch Them Falling and Watch Them Grow" advises clients to pick up shares in Maruti, Bharti Airtel, Jubilant Foodworks, Dish TV, Zee, Voltas, Mindtree, Aurobindo Pharma, Axis Bank, LIC Housing, SKS Micro, Ultratech and NCC. The idea here is simple. Local investors should profit from times when global investors turn cautious and choose cash over stocks. Not surprising, considering the overall feeling is that India cannot be written off just yet. Despite the recent sell-offs, India remains one of the best performing emerging markets. It has outperformed the MSCI EM index by nearly 10% so far in the second half of 2015. This has experts like Prabhat Avasthi of Nomura advising clients to pick stocks that will benefit from changes in the macro environment. His top 5 picks: Asian Paints, HUL, HCL Tech, M&M and Ultratech. In Mumbai with Nimesh Shah, Alexander Matthew.
So brokerage is advising buying on the dips that we're currently seeing in our markets. But let's take a quick check of the rupee and how it fared today. It finally ended marginally lower by about 3 paise to close at 66.13 against the dollar. The rupee has fallen by about 3.4% in August itself. And this month has been the worst month for the rupee in the last 2 years. But let's talk about the most influential voice in our markets, RBI Governor Raghuram Rajan. He doesn't expect the recent steep falls in the financial markets to get as bad as the Asian financial crisis of 1997. Speaking to Karishma Vaswani for BBC World News' India Business Report, Rajan also cautions that not all the movements in the market can be attributed to what's going on in China. There are also questions about the high levels in some markets and the impending normalization of rates by the US Federal Reserve. Here's a slice of that conversation.
Stock markets tend to look forward. I think they're seeing a slowdown in China, and perhaps they're reacting accordingly. So I think there are a variety of forces at work. I don't think all of them are a reflection on China's future, which, given their 7% growth, may still be seen by many as very reasonable.
So you see this more as a major correction as opposed to the talk that we're hearing about another Asian financial crisis or a global financial crisis?
Based on what I've seen so far, there is no strong reason to believe we are on the verge of another crisis like we saw in '97. But I think what we have to do is be vigilant about the kinds of fragilities that have built up over the last few years and tackle them directly.
how bad do you think the slowdown will be for China, for the global economy, and for India's economy?
Well, there's a lot of uncertainty about what the real numbers are here, right? Because the numbers have to come out. But China as a big country has become very important to the global economy. Every adverse development across the world affects the rest of the world in some ways. It works through the financial markets first, works through trade later. So it is something that everyone should be concerned about. But I think you have to be a little careful about attributing everything that's going on to just China. There are a number of concerns that the global economy has, including when rates normalize. The Federal Reserve may well be the first off the block, so there are questions about when that will happen. There are also, questions about the levels of various markets. Are they too high?
There's a lot of talk about how that engine of growth, the Chinese engine of growth, will no longer be able to lift global growth. Can India replace that?
Well, India's 1/4 to 1/5 China's size. So even if we can, overtake China in terms of growth rates, the magnitude of the effect will be far smaller for a long time to come.
Well, that's the RBI Governor Raghuram Rajan saying not everything that we're seeing in global markets can be attributed to what's going on in China, but doesn't believe that the crisis that we're currently seeing is a crisis that resembles 1997. Now, shift focus to Asia, where China's stock market has fallen again for the 5th day running, but it did come off its intraday lows, and this despite the fact that the Chinese central bank intervened yesterday to try and calm the crisis by cutting interest rates. The Shanghai Composite finally closing 1.3% lower. That drags the index back below the 3,000 mark, making it the lowest since December of 2014. Now, after today's slump, China's central bank, the PBOC, also announced that it's injected 140 billion yuan into the money market via the short-term liquidity operations. The facility is mainly used to provide 1 to 3 day direct lines of credit to commercial banks. Authorities in China will also restrict trading in stock index futures. This as regulators step up efforts to try and curb speculation. Yunus Yoon joins us now from Beijing. Yunus, does the Chinese government have enough resources in its arsenal to try and stem this crisis?
Chinese government still has a lot of resources at its disposal. If it wants to, it could pump more money into the market. It could cut interest rates. It could cut the RRR, again, as many analysts expect. It could also direct companies as well as funds to buy more stocks. Over the weekend, the authorities approved regulations that will allow more pension funds to do just that. The authorities here could also stimulate the broader economy through infrastructure spending, for example, to try to lift confidence and sentiment. They could also take more unorthodox measures, which is in fact what we saw today. The futures exchange said that they were going to restrict index futures trading. The Xinhua, the state media news agency, also called for a purification of the capital markets, and that coincided with the police saying that they're going to step up efforts to investigate insider trading or anyone involved in illegal stock investing or spreading false rumors. Now, just how much of an impact any of this is going to have is still very unclear. The interest rate cut didn't have the desired effect on the markets. The markets today were struggling to stay in positive territory. Also, if you look at social media and all the chatter there, most people still do not have much faith in the government's ability to manage the markets. Back to you.
Thanks, Eunice, for joining us. With that, let's tell you about the other Asian markets and how they fared in trade today. They started, shaking up a global rout today after China's central bank took steps to address the country's deteriorating economy. That's, of course, by cutting lending rates. So you have the Nikkei, the Japanese Nikkei, in the green by 3.2%. The South Korean Kospi up by about 3%. The Hang Seng in Hong Kong, meanwhile, not faring too well, up by about 1.5%. How are the European markets closed today, Shireen?
Well, they were up, but they have given up those gains and have ended in the red. Let's bring up the European markets for you. The FTSE closing by about 1.5% lower, and the DAX and the CAC also closing with similar cuts. But across the Atlantic, at the US market, stocks jumping in opening trade, attempting a second-day bounce back from the recent correction that we've seen. That's the Dow for you, higher by about 1%, and the S&P and the Nasdaq continue to trade by about 1% higher, but they have given up their intraday gains, or some of their intraday gains. But Nentara, all eyes now on what the US Fed is likely to do.
Or not do, Shireen. That's the big question. Some decent economic data Orders for durable goods spiked by 2% in July, surprising economists who had expected a 0.4% decline. We also saw some highly awaited Fed speak today. Federal Reserve policymakers William Dudley today declared that a September interest rate hike is less than likely, something we picked up from the FOMC minutes. Listen in.
From my perspective, what we're going to do is data dependent, but data is not just about the economic releases, monthly economic releases that come out, which have actually been pretty positive, frankly. If you look at what we got over the last couple of days, consumer confidence showed a good increase. New home sales were solid. The durable goods orders report was quite strong. So that's part of the story, but you also have to look at all the other things that potentially could affect the economic outlook. I mean, at the end of the day, we're concerned about the outlook. How's the economy going to perform in the future? So it's not just how we're performing today, it's all the things that affect the outlook beyond the next few months. And I think there, international developments and financial market developments do have relevance because they can impinge and affect the economic outlook. So to me, it's a broad set of information. So when I say data dependent, I mean all those things. From my perspective, at this moment, the decision to begin the normalization process at the September FOMC meeting seems less compelling to me than it was a few weeks ago. But normalization could become more compelling by the time of the meeting as we get additional information on how the U.S. economy is performing.
Well, that's the word coming in. A September liftoff by the U.S. Federal Reserve looks less compelling at this point in time, and that's, of course, been the word that we've been picking up from global experts over the last 48 hours. Now, the cabinet back home has had a fruitful meeting with a flurry of decisions being taken. Here's a quick wrap of those. The Cabinet Committee on Economic Affairs has tweaked the rules governing road projects done under the Build, Operate, Transfer model to expedite the award and implementation of highway projects, permitting 100% equity divestment in all such projects 2 years from the date of complete construction, irrespective of the year of the award. Proceeds can be used for any highway project, including the incomplete NHAI projects, power sector projects, and even retiring debt taken for any other infrastructure project. So that's been the latest there as far as the roads and highways sector is concerned. And Tarak.
And Shireen, the Cabinet has also approved amendments to the Arbitration and Conciliation Act 2015, and that's as per the recommendations of the Law Commission and stakeholder feedback. Amendments call for full written disclosure from potential arbitrators of any relationship with either party, set a 12-month deadline for award, and extendable by any party for a maximum of 6 months. Also allows for fast tracking of arbitration, redefining public policy for purposes of challenging an arbitral award, and gives the courts 1 year to dispose of such challenges. So in long and short of it, it basically means quicker arbitration.
But it's not done till it's done, and it has to go through Parliament. So this is just a cabinet approval that's come in as far as the amendment to the Arbitration Act is concerned. But that's not all. The 7th Central Pay Commission's plea for an extension has been granted. The cabinet has approved extending the Pay Commission by 4 months up to the 31st of December this year. The schedule was expected to expire on the 31st of this month, and it has now been extended to December. But 2 communities from Gujarat and 2 communities from Uttarakhand are added to the central list of OBCs. The cabinet has approved making people belonging to the Sipai Patni Jamaat, Kahar and Tanbar Singharia communities eligible for all welfare schemes and scholarships administered by the central government. On to another story that we've been tracking here. The land ordinance is all set to lapse on the 31st of August, and re-promulgation is not possible unless this session is prorogued. So now the government is exploring issuing an executive order to ensure that there is continuity. We learned the Attorney General has opined in favour of the government issuing an executive order, keeping 3 of the 9 changes made to the original Land Acquisition Act. And the Union Parliamentary Affairs Minister Venkaiah Naidu told CNBC TV 18 today that the 13 other acts that were brought into the land ordinance will be adversely impacted if the land ordinance lapses, and hence the government is exploring all options to ensure continuity.
We have the land bill also pending, because land bill is also equally important, because if you don't legislate those 13 central acts which were not covered by 2013 Act, that will be excluded and the farmers will be put to huge loss. GST is the need of the hour. It's a very progressive, revolutionary taxation legislation where there is broad consensus. For whatever reason, we could not get it approved in the last session. And then I have to call both the houses, because you can't have a joint session for the bill like GST, which is a constitutional amendment.
This Venkaiah Naidu saying 2 days in a row the government, hinting rather the government is looking at re-promulgating the land ordinance to ensure continuity. Now, according to legal experts, the government's decision to ensure that continuity of land ordinance by passing an executive order would require it to walk a thin line. Experts are of the opinion that any such order passed will have to be made within the confines of the 2013 Act. Ashmit Kumar now joining us to break down this entire issue for us. Ashmit, whether it's the states having the free hand or whether you have an executive order, the government cannot seem to bypass the 2013 Land Act.
Well, that appears to be the case, at least the consensus among the constitutional experts as far as the road ahead is concerned. Of course, the Parliament finds itself in a sticky position as far as the re-promulgation is concerned. That has clearly been ruled out. The Parliament continues to be in session. It's not been prorogued. So as of now, this is the opinion that has been expressed by the Attorney General himself, that re-promulgation is perhaps out of the question as of now, which of course brings the focus back to alternatives. What we understand is that the government might be considering executive orders to ensure continuity, but that's where the legality of it all begins to unravel. What we understand after speaking to constitutional experts is that when the re-promulgation, in fact, if it is not re-promulgated, the land ordinance, it will essentially mean a move back to the 2013 Act, which in turn would mean that executive orders, if any that are passed, would have to be passed within the confines of the 2013 Act, that the mandate of the 2013 Act cannot be exceeded. What that net means is that the government will have to walk a very thin line, as any attempt to incorporate provisions of the land ordinance under the Act of 2013, bypassing executive orders, could in fact invite stiff legal opposition in the Apex Court. In fact, a PIL is already pending before the Apex Court, which questions the land ordinance itself. So clearly, whichever course of action that the government now embarks upon between now and 31st of August, that's when the ordinance lapses, it will be subject to stiff and rigorous legal scrutiny. Back to you.
Well, that is right, and we are still trying to wrap our head around the fact of that executive order and the tenability of that executive order. Ashmit, appreciate you joining us. But Maharashtra is moving quickly to formulate its policy on organized retail. According to the draft framework being discussed with stakeholders, the government seems to be willing to go all out to give a boost to retail development. The draft policy not only proposes to give significant real estate subs to retailers, but also seeks to provide more employment opportunities. Priya Seth and Arundhati Ramanan have the details.
Maharashtra is looking to revive the sliding fortunes of brick-and-mortar retail in the state. The state government is working towards a new multi-brand retail policy, and the draft note promises a big boost to both retailers as well as real estate players. The draft policy proposes single window clearances for license procurement and creation of retail entertainment zones. A big thrust on retail space development is also on the cards, and the state government is looking at amending the development control regulations to facilitate the same. The proposed changes include giving malls a higher ground coverage of up to 70% and raising the floor-to-floor height limit to 5.5 meters. Developers may also be allowed to build larger car parks without having to pay for additional FSI or floor space index. Next comes relaxing mall and other retail establishment timings. This will be done by amending the Shops and Establishments Act to allow retail enterprises in the state to stay open from 5 a.m. to 11 p.m. Another major change in the draft retail policy is the proposal to amend the APMC Act so that farmers can sell their produce directly to retailers. The draft also suggests allowing organized retailers to set up warehouses on agricultural land and on a PPP basis. The Maharashtra government is still inviting comments on this draft policy, and initial views indicate that small traders may not be very happy with some of the proposed changes. Interestingly, while the draft policy addresses several critical areas, it is strangely silent on the issue of FDI in multi-brand retail. In Mumbai with Priya Seth, Arundhati Ramanan.
Maharashtra's draft policy, especially as far as multi-brand retail goes. The government is trying once again to allay fears, with the Revenue Secretary recommending once again that the government has no intention whatsoever of banning P-notes in the country. Speaking at an event in Mumbai, Shaktikanta Das of the Finance Ministry said North Block already in talks with the market regulator to try and streamline the process, which will address concerns of black money being routed via participatory notes without banning them. All of this coming to the forefront after the SIT's recommendations.
It is nobody's intention to ban P-notes overnight. The SEBI has improved the P-note regime over the years. the KYC requirements have been improved by the SEBI over the years. The SIT, that is a special investigation team constituted by the government as per directions of the Supreme Court, the SIT felt that there is need for further improvement in the KYC regime of, KYC regime which governs the P-notes. And the government is in consultation with the SEBI and the RBI and other stakeholders, including the investors and FIIs, before any further decision is taken.
Well, that is not the first time that we've heard the government try and allay concerns on the P-note issue. That's the Revenue Secretary reiterating what he has been saying to us here on CNBC TV 18. But on that note, it is time for us to wrap up this edition of India Business Hour. Stay tuned to CNBC TV 18. Tomorrow promises to be another volatile day for our markets as the expiry jitters add to all the volatility. And of course, we'll tell you how the global markets ended for the US, and we'll tell you how Asia starts to trade. From all of us here for now, goodbye. Thanks for watching.